Hey, Alex here to help tutor. This is cost accounting, accounting 203, and spring break's over. I hope you all had a good spring break. Now it's time to get back into it. Cost accounting is one of the most important accounting classes because it really helps you understand what the cost was to you of making a product. So manufacturing, you got to think manufacturer, factories. And so there's a good intro right here. Mr. Ackerson, CEO of GM, said the Chevy Volts cost $41,000 to sell. That's how much they charge to sell a Chevy Volt. But he said, how fast can you take $10,000 out of the cost? So when you think of it a business, or if you have a business, or you're thinking of maybe cut, or maybe lower, maybe you want to make more money, sometimes making money isn't about increasing your revenue as much as lowering your cost. And by lowering your overhead or your cost of making something or anything like that, you actually make your revenue go farther. So instead of always thinking, oh, I need higher revenue, start thinking it's good to have some high revenue. You know, it's never bad to go for higher revenue, but also don't forget to push costs down. Look where you're spending. Look where you could say, oh, let's shop around. You know, like we were paying, my wife and I, $40 a month each of us for a phone, and we found that oh, we can pay for the same phone. We could just we could have a phone for $5 a month. So our bill went from 80 to 10, and that's a cost-cutting mechanism. So cost cutting, sometimes you got to think cost a lot of times. So cutting costs saves you money, makes your money go farther. So we'll jump right into this. We start with manufacturers convert purchased raw materials into finished goods by using labor, technology, and facilities. Merchandisers purchase finished goods for resale. They may be retailers who sell to individuals for consumption, or wholesalers who purchase goods from manufacturers to sell to retailers. So manufacturers take the raw stuff, like wheat, lumber, they take the people, and they take the factory or the building, and they combine them to make a product. They convert it into an output, to goods, and then they sell those goods to wholesalers who then distribute it to the retailers. And then the retailers sell it to you, the consumer. And so that's how the chain goes. So they need their own accounting system to deal with the differences. There's a lot of differences because you're making products out of thin air. So you have to find out how much it's costing you to make. Because then when you make it, it's not free just because you made it. There is cost that goes into manufacturing. And cost accounting is a mix of financial and management. So managerial accounting and financial accounting come together to make cost accounting. So we'll start with cost of goods sold. There is a cost of goods sold, but it's changed the name. So you take your beginning merchandise inventory. The old way was taking beginning merchandise inventory plus purchases, gives you merchandise available for sale, less your ending merchandise inventory gives you cost of goods sold. Throw that out. Now we have beginning finished goods inventory. So now we have finished goods plus cost of goods manufactured gives you finished goods available for sale, less ending finished goods gives you cost of goods sold. So the term finished goods inventory replaces merchandise inventory. That's the new thing. That's the new thing about this. And the term cost of goods manufactured replaces purchases in determining the cost of goods sold. So don't fret. So remember, cost accounting is in between financial and managerial. So they use a lot of the same aspects. So here, in a normal merchandiser, you'd have current assets would be cash, accounts receivable, merchandise inventory. But under a manufacturing balance sheet, it would be current assets again, but it'd be cash, accounts receivable, and then inventories. And it's broken up into three things: finished goods, work in process, and materials. And so finished goods is basically your inventory. It's what you have after you're making the product. And the finished goods is what you're going to sell to the wholesaler. So we have three new accounts: manufacturing and production costs. They're classified into three basic elements: direct materials, direct labor, and factory overhead. Direct materials that become a part of a certain manufactured product can be readily identified with that product or classified as direct materials. So direct materials are the lumber in making furniture, fabric used in making clothing, iron ore used in manufacturing of steel products, and rubber used in production of athletic shoes. So that's like the big stuff, the lumber, the iron that you take, this raw stuff that you're actually going to make into an object. But sometimes you might have small materials, small supplies that are necessary, but you can't really identify them to a particular item, and they're relatively significant cost. That's an indirect material. So screws, thread, rivets, nails, glue, those costs are so insignificant that they're going to be indirect materials. So you're going to put them to factory overhead, and you'll see that. So remember that anything insignificant in cost will be indirect materials, does not go under direct materials. You can just throw it into factory overhead. Okay, direct labor, the labor of employees who work directly on the product. So someone who works directly on the product being manufactured, such as machine operators or assembly line workers, is classified as direct labor. So employees who are required for the manufacturing process but do not work directly on the units being manufactured, they are considered indirect labor. So supervisors, inspectors, factory maintenance personnel, materials handlers, they're going to be indirect labor. They're going to be factory overhead because you can't really assign them to any particular product. So every product will bear the cost. You see, that's the difference. And same with indirect materials. Any factory overhead is your catch-all. And then we'll get the factory overhead, also known as manufacturing overhead, and factory burden. Includes all costs related to the manufacture of a product except direct materials and direct labor. So everything else falls into that. Thus, factory overhead is depreciation, insurance, property taxes, rent, janitors, heat, light, power, maintenance. All that is going to be passed down to the cost of your goods because, you know, your insurance, your taxes is all part of having that building. So you got to pass that cost onto the items you're making so that you can when you can charge over that and make a profit. Okay, now there's summary of manufacturing costs. There's flow of costs. The elements of costs are direct materials, direct labor, factory overhead. So the prime costs are direct labor and materials. Direct labor and materials is prime. Direct labor and factory overhead is conversion. That's the cost of conversion. The cost of converting is direct labor, factory overhead. The prime cost is always direct materials, direct labor. And here's the flow of manufacturing costs. So it goes direct materials, direct labor, factory overhead. It goes into work in process, which is an asset. Then it goes into finished goods, and then it goes into cost of goods sold. So that's the flow. So the three things go into work in process, become a finished asset, finished goods, and then become expense as cost of goods sold. So and once again, I'll do another video on an example problem, how to classify costs. But for now, we'll just get through this. What is it? Oh, okay. There's two different ways to have a cost accounting system. There's special order costs. A special order cost system is a special made or custom made products. So in other words, each product is made to order. An example would be custom built homes, machine tools, engines, structural wheels, books and magazines, directories and catalogs, specialty shops, making a boat, making a plane, Boeing. You make one thing for one person or individual or entity. And so you'll cost it out just for that. And the other kind of manufacturing is continuous or mass production process. So this is like Toyota, Prius, Pepsi, Coke. They make lots of the same thing at once on a factory. So like they'll make 10,000 bottles of Coke. at once. Instead of one bottle of, instead of having to order one bottle of Coke, oh, I want to order, I want a bottle of Coke Pepsi. Could you make a special order? It doesn't make any sense. People are going to want the drink no matter what. So just make a whole bunch of them, and then that way they're already made, and then it speeds up production, and people can buy as many as they want. So a process. Oh, and another thing is the job order cost system uses a job cost sheet. So each job will have its own cost. But under a process cost system, it accumulates cost for each department or process in a factory. So if the first process is mixing the water and the sugar and the flavoring, then the next process is going to be bottling it, and then the final process is just putting the label on. See how you separate the duties? So process costing is you assign cost on different parts of completion. So if you're making a chair, let's say you make chairs in a factory, you're going to first take the lumber, make it into the beams, then you're going to put the beams together, and then you're going to maybe stain it. So it's 3 processes. So there's going to be 3 different departments that are going to have their own costs associated. And you're going to add them all up at the end and see what the chair cost you. And here's the thing about process costing is the more you make, the cheaper it is. Because if you made 10 chairs, no, let's say you made 1 chair for the month, but your rent was $10,000. That chair cost you $10,000, so you're going to have to charge $11,000 or whatnot. But if you made 10,000 chairs and your rent's only $10,000, the cost is $1 per chair. So the more you make on an assembly line, the cheaper it is. See how you... Okay, here's some examples. A job order for a service business would be accounting firm, plumber. Merchandising business would be lumber company, personal computer retailer. And a manufacturer would be custom home builder, shipbuilder. Under process, a service business would be airline, hotel, housekeeper. Merchandise business would be newspaper publishing, agricultural, wholesaler. And manufacturing would be soft drink bottler, paper products, paper producer. So that is the different kinds of way to cost out things. And the first chapter is very simple. It's just pretty much understanding the different processes. And I can explain, like one of these ones is, materials are purchased on account at a cost of $25,000. So you're going to debit materials, and you're going to credit accounts payable. Same for $25,000. So nothing's changed. There's still journal entries. During the month, direct materials costing $20,000, and indirect materials, nails, tacks, staples, glues, and solvents for cleaning costs $995. So you're going to debit work in process for the $20,000. You're going to debit factory overhead for the $995, and you're going to credit materials. So as you can see, you move the materials that we just have and put them into the right spot. So direct materials go into work in process, indirect go into factory overhead. And then what you're going to end up doing is at the end, you're going to dump all that work in process. So first of all, factory overhead, the factory overhead that you debited, you're going to credit it and dump it into work in process. So all the factory overhead you've accumulated, you're going to dump it back into work in process. Work in process is going to get credited for the full amount, and you're going to debit finished goods. So as you can see, things go, they turn into one thing, turn into the other, and end up a finished good. It's just it's assembly line. So costs get passed down. And wages. So your payroll for the month was $20,000. So you're going to debit payroll. You're going to credit wages payable. And then when you pay it, you're going to debit wages payable, credit cash. Not too bad. But here's the thing is when you have to, the difference is now you have to distribute the payroll. So you're going to credit the payroll we just debited. And up here it says $10,000 was for people working on the product. $3,500 was for factory supervision, and $6,500 was for office people. So you're going to debit work in process, $10,000 for the direct labor. You're going to debit factory overhead for $3,500 for the supervisors, factory supervisors, and maintenance and custodial employees, janitors. And you're going to debit selling and admin salaries for the sales and the office people, and they're just expensed for $6,500. And as you can see, you put the right labor in the right area, but at the end you'll dump it all back into work in process, and then you'll dump all that into finished goods. So that's the biggest difference, really, of the cost accounting. And so thank you very much. I wanted to keep it. There wasn't too much to it. I didn't want to keep it kind of lean, but I'll do a problem. Just explaining what would be direct labor, what would be factory overhead, what would be cost of goods sold, and I'll be back. Hope this helped. And I used my Kindle Fire. I put it up, straight up and down to try it out this way. But if people don't end up liking it or I don't like it, I'll go back to the sideways. And I felt like this way would be kind of neat to try out. You get more upper level of this way. So thank you very much, and if you have any questions about anything, feel free to comment or ask, and I'll see you again.